Harsha Upadhyaya joins us. Harsha, good morning. Thank you for joining us. Gold and equity, they both are extreme ends. One represents fear, other represents safety. If you're buying stocks, your view is that the world will get better. If you're buying gold, your view is world is getting worse. How come they both are at an all-time high? I mean, it's one of those days, Harsha, where the housewife is saying, look, I told you to buy gold. I'm very happy. The man in the house is saying, I told you to buy equities, I'm very happy.
Good morning, Nikhil. Absolutely true. I think it's being driven by liquidity, which is crashed all around. So to that extent, most of the asset classes are giving higher returns in the recent times. But as far as equity is concerned, clearly there was a case to not to panic at the lower levels, given that the valuations had corrected meaningfully. Now, in the past 2.5 months, we have seen a significant rally in Indian equities in terms of valuations. So at these valuations, we remain a little bit cautious because of the fact that earlier, at least, the Bharat was not really facing pandemic issues. But now, some of the cities which had higher number of cases in the earlier times have all started flattening, but the cases have moved to the hinterland. So to that extent, I think we need to remain a little cautious at this point of time and wade our way through.
Sarsha, as long as a fund manager has reliance in their portfolio, it's a great market. The minute your weightage in Reliance is 5% or less than 10%, it's bad news. How are you dealing with this kind of a market where one side you have a benchmark to beat, and second side you have a risk and a compulsion that you cannot go in a stock above 10%?
No, it's very, very challenging for active managers. For example, we have been holding the stock for the last several years and we have been happy about holding it. But the fact is, even after holding it for several years, our weight remains an underweight, given the fact that there is a cap of 10% in a single stock for active portfolio managers. So to that extent, we have to make up that weight to other stocks, which will also move similarly in terms of stock price performance or better than what the stock has done. So it's obviously challenging for active fund managers. As it is, the market has been very narrow. And within that, you have two stocks in the index, which are more than 10% at this point of time. So it's difficult and challenging for active fund managers.
Harsha, hi, morning. It seems like IT could well compensate for the banking weakness. Globally as well, one is seeing the trend wherein tech stocks are holding up. If I just look at the big five IT names, solid performance, solid market reaction. Do you think IT is a firm investment for the foreseeable future?
If you look at the management commentary, that has changed quite a bit in the last couple of months. It has changed for the positive. The delivery was also much better than what the street was expecting on at least some of the large cap names. The margins have held on simply because the levers on cost cutting have been significant for some of the IT companies, and they have used that. So overall, from a revenue perspective, I think things have started to improve a bit. Yes, there are verticals which are significantly affected, for example, aviation, retail, etc. But there are also other verticals which are making up for a loss of revenue in these segments. And overall, the margins are holding up. And the fact remains that IT sector has one of the best balance sheets across sectors. So to that extent, I think in times of crisis or when you don't have much of positive news coming from elsewhere, you tend to go overweight on this sector. So clearly, this remains one of the areas where one could hide at this point of time.
Harsha, the other interesting trend which is emerging and an ancillary of higher retail participation, I mean, call it work from home, hobby trading, Robinhood traders, whatever term you want to give them, is that platform companies tend to do very well. You know, the likes of an MCX, BSE, etc., some from the unlisted universe as well. Do you think this is an interesting pocket to look at?
Yes, at least in the months of May and June, most of the retail brokers have seen all-time high turnovers and volumes. So clearly, while it may not be getting depicted in terms of flows into mutual funds, the retail investor interest is clearly directed towards direct equity participation. which if it continues, then obviously it will benefit some of these platforms. But for these platforms to really do well, you need institutional volumes also to go up. At this point of time, while there is a bit of liquidity that is getting used from an institutional perspective, at least for domestic institutions, we are not seeing any great inflows. So to that extent, I think institutional participation will remain muted, at least in the short term.
Okay, great. Harsha, in terms of just how you see the mix shaping up, I mean, there continues to be that extreme focus when it comes to the financials. We've seen this spate of fundraising. You've heard some of the commentary. We still have some key numbers this week. Are you concerned at all with regards to any kind of risk to do with moratoriums or otherwise over the next few months? Do you feel we are well placed to overcome any potential challenges and continue to remain bullish on some of those leaders there within that pack?
See, the real challenge has been to assess the credit quality and the asset quality trends that will emerge post-moratorium. So as long as the borrowers are in moratorium, it is very difficult to predict what kind of asset quality trends or credit costs will emerge for banks and financials. On the other hand, there are also a couple of financials and NBFCs which are still not fully cushioned in terms of the capital adequacy. So we need to separate them out. So overall, our belief is the credit costs and the asset quality trends will be available for the banking sector as a whole, only starting from December quarter onwards. So that is the time you will be able to really assess in terms of what valuation you are playing and what is the risk that is there in the balance sheet. And we are sure that not all of them are going to really come out covered with glory during this crisis. There will be issues that some of the financials will have to face. So to that extent, we have been avoiding or being negative on NBFCs and public sector banks at this point of time. Even within the private sector banks, we have consolidated our position in the top 4 or 5 banks, where at least capital is not going to be an issue. Some of them have already raised capital and others are in the line to really raise money. And we believe that going by the past trend, some of these banks are likely to come out much better in terms of the asset quality, even during this cycle. So overall, our view on financials has been cautious and we are underweight as a basket. But there are a couple of large private sector banks which are overweight in our.
Okay, so that's on the banks as well. In terms of the recovery, Harsha, I want to get your sense because we've been hearing trickles of information or suggestions that things could be picking up, but on ground, it still seems like it's going to be a long, painful procedure. How confident are you again? What are the kind of timelines you're looking at right now where a lot of companies are banking on the rural recovery, whereas urban centers are still struggling to kind of revive. Do you see this taking well into next year, or are you thinking more about 3-4 months down the line?
There will be some sectors which will possibly start to recover much earlier than the rest of the economy. But as you clearly pointed out earlier, it was more because of the rural demand which was really coming up. While some of the large cities still had the large infection rates, the hinterland was not so affected during I would say May and June. And you also witnessed some amount of pent-up demand, possibly in the months of May and June, when the markets opened up for the first time after a couple of months. Now, I think the real question is whether the infection rates which are going up in rural areas or tier 2, tier 3 towns, what will it how will it impact the consumer demand? I think that's what we need to see. If the demand continues to remain at the June levels going forward as well, or if it improves from those levels, then we would say that at least there will be a couple of industries which will be back to normal by end of this calendar year. If the rural areas start to go into kind of a mini crisis in terms of coronavirus, then you would say that the recovery would be a little more back-ended, which means that maybe end of the financial year or early part of the next financial year is when you will see normalcy coming across most sectors.
All right, Harsha, really appreciate your time. Well, when the stock is on the roll, it doesn't matter what brokerages say. That's markets for you. It can remain extended, in some case overextended, in some case euphoric.